Hello everyone. Today, we gonna be to learn top 10 best investment in 2023. A lot of investors may have been worried about the economy after high inflation rates and the Federal Reserve raising interest rates in 2022. Stocks spent most of the year in a downturn, even entering a bear market, and with a recession seemingly on the way, investors may not have a lot of faith in the markets right now, and that could be affecting their choices. But if you look 10 years from now, 2023 will be the most profitable year to invest your time and money in. So what are the best investments for this year? The following assets are safe and should deliver steady profits, leaving plenty of room for sustainable growth. On the other hand, these are more volatile assets that could see a big payout but will also face high levels of risk. Why invest? Investing can provide you with another source of income, fund your retirement, or even get you out of a financial jam. Above all, investing grows your wealth, helping you meet your financial goals and increasing your purchasing power over time. Or maybe you've recently sold your home or come into some money. When it comes to investing, there's no shortage of choices. But understanding what you need to invest in and when can be complicated. It's a wise decision to let that money work for you. While investing can build wealth, keep in mind that although you have the potential to earn more, there is always risk involved. It's also important to have manageable debt levels, a good emergency fund, and be able to ride out the ups and downs of the market. There are many ways to invest, from very safe choices such as CDs and money market accounts to medium risk options such as corporate bonds, and even higher risk picks such as stock index funds. So that's good news. It means you can find investments which meet your different risk profiles and get the investment returns you want. It also means that you can combine investments to create a well-rounded and diversified portfolio. This is safer because it won't be so heavily weighted in any given sector or asset class. Best investments in January 2023. Number 1. High-yield savings accounts. A high-yield online savings account. Online savings accounts pay you interest on your cash balance, just like a traditional bank account. But what's different is that you can access them anywhere, and they provide higher interest rates than traditional bank accounts do. Who are they good for? A savings account is a good option for those who will be needing cash in the near future. It is also a good account for those who are risk-averse and want to avoid their money going to waste if they don't get what they invested. Risks. The banks that offer these accounts are FDIC insured. Renters insurance can help protect your property investment with financial protection in the event of damage or destruction due to natural disaster. While high-yield savings accounts are considered safe investments, like CDs, you do run the risk of losing purchasing power over time due to inflation if rates are too low. Bank rewards. With less overhead and fixed costs, you can typically earn a much higher interest rate at an online bank. Number 2. Short-term certificates of deposit. Overview. Low-risk investments, CDs typically offer higher rates of return than ordinary savings accounts. A short-term CDs may be a good option for customers who think interest rates are going to go up in the near future, as its value can be reinvested at the higher rate. Who are they good for? Because of their safety and higher payouts, CDs can be a good choice for retirees who don't need immediate income and are able to lock up their money for a little bit. CDs are often a good alternative for conservative investors who cannot afford risk and need money on demand, but do not want to pay too much interest. This type of investment is low risk and stable, and does not require a large sum be invested from the very beginning. Risks. CDs are considered safe investments, but they do carry reinvestment risk. The risk that when interest rates fall, investors will earn less when they reinvest principal and interest in new CDs with lower rates, as we saw in 2021 and 2022. The danger of an increase in interest rates is that it could put investors on the losing end as they are unable to take advantage of financial opportunities. And with rates expected to rise even further in 2023, it may make sense to stick to short-term CDs so that you can reinvest at higher rates in the near future. It's important to note that inflation and taxes could significantly erode the purchasing power of your investment. Rewards. When you deposit money with a CD, the bank pays you interest regularly. Once your CD matures, they return your original investment plus any interest you have earned. Where to get them? Bankrate's list of best CD rates will help you find the best rate across the nation. instead of having to rely on what's available only in your local area. Keep in mind that traditional banks and credit unions usually offer CDs, but you may not find the best rates in your city. The number 3. Series I bonds. Overview. The U.S. Treasury issues savings bonds for individual investors, and an increasingly popular option is the Series I bond. The interest rates for the bonds are adjustable and the rate of return depends on the inflation level. The result: if inflation rises, so does the payout. But the reverse is true. If inflation falls, so will the interest rate. The inflation adjustment resets every 6 months. Who are they good for? Like other government-issued debt, Series I bonds are attractive for risk-averse investors who do not want to run any risk of default. These bonds are also a good option for investors who want to protect their investment against inflation. Investors can only buy $10,000 worth of I bonds in any given year, $5,000 with their tax refund. And there's a little-known secret to get around that annual limit too: risks. The Series I bond protects your investment against inflation, which is a key downside to investing in most bonds. And like other government-issued debt, these bonds are considered among the safest in the world against the risk of default. Rewards. Series I bonds earn interest for 20 years if they are not redeemed for cash, but the rate will fluctuate with the prevailing rate of inflation. Where to get them? You can buy Series I bonds directly from the U.S. Treasury at treasurydirect.gov. The government won't charge you a commission for exchanging your old currency. 4. Short-term corporate bond funds. Corporations sometimes raise money by issuing bonds to investors, and these can be packaged into bond funds that own bonds issued by potentially hundreds of corporations. Short-term bonds have an average maturity of 1 to 5 years, which makes them less susceptible to interest rate fluctuations than intermediate or long-term bonds. Who are they good for? Corporate bond funds can be an excellent choice for investors looking for cash flow, such as retirees or those who want to reduce their overall portfolio risk but still earn a return. Short-term corporate bond funds can be good for those who are more risk-averse and want a higher yield than government bond funds. Risks. As is the case with other bond funds, short-term corporate bond funds are not FDIC insured. Over time, companies need to pay back the money they borrowed from their bondholders. If it becomes impossible for them to do so, the chance of having their credit rating downgraded or going bankrupt increases greatly. To reduce that risk, make sure your fund is made up of high-quality corporate bonds. Rewards. Investment-grade short-term bond funds often reward investors with higher returns than government and municipal bond funds. But the greater rewards come with added risk. Where to get them? You can buy and sell corporate bond funds with any broker that allows you to trade ETFs or mutual funds. Mutual funds may be better for some people because they do not always have a commission fee, whereas ETFs don't always include a commission fee. Number 5. Dividend stock funds. Overview. Dividends are company profits that can be paid out to the owners of said company, usually occurring at a 4 to 6 month interval. They're often paid in cash, but sometimes they're paid in stock instead. So dividend stocks are those stocks that offer a cash payout, and not all stocks do, while a fund packages up only dividend stocks into one easy-to-buy unit. Who are they good for? Buying individual stocks, whether they pay dividends or not, is better suited for intermediate and advanced investors, but you can buy a group of them in a stock fund and reduce your risk. Dividend stock funds are a good selection for almost any kind of stock investor, but can be better for those who are looking for income. People who need a more consistent income source and can stay invested for at least a few years might find these attractive. Risks. Dividend stocks are a type of riskier stock. They're considered safer than growth stocks or other non-dividend stocks, but you should choose your portfolio carefully. Make sure you invest in companies with a solid history of dividend increases rather than selecting those with the highest current yield. That could be a sign of upcoming trouble. However, even well-regarded companies can be hit by a crisis, so a good reputation is finally not a protection against the company slashing its dividend or eliminating it entirely. However, you eliminate many of these risks by buying a dividend stock fund with a diversified collection of assets, reducing your reliance on any single company. Rewards. Even your stock market investments can become a little safer with stocks that pay dividends. With a dividend stock, not only can you gain on your investment through long-term market appreciation, but you'll also earn cash in the short term. Where to get them? Dividend stock funds are available in either ETFs or mutual funds at a variety of brokers. ETFs often have no minimum purchase amount and so may be more advantageous because they typically have lower commissions. Fund managers often require a minimum investment and usually charge for it. This may depend on the manager, so be sure to look over their commission example fees before you decide to purchase. Number 6. Value stock funds. Overview. These funds invest in stocks that are undervalued, selling at a lower price than the company's actual value. Who are they good for? When stocks run up in valuation as they do from time to time, many investors wonder where they can put their investment dollars. Value stock funds may be a good option. Value stock funds are good for investors who are comfortable with the volatility associated with investing in stocks. Investors in stock funds need to have a longer-term investing horizon. 2. At least 3 to 5 years to ride out any bumps in the market. Risks. Value stock funds will tend to be safer than other kinds of stock funds because of their bargain price, but they're still composed of stocks, so they will fluctuate a lot more than safer investments such as short-term bonds. Value stock funds are not insured by the government either. Rewards. They'll do better than growth stocks, which tend to go down as interest rates rise. Many value stock funds also pay a dividend, so that's an additional attraction for many investors. Where to get them? Value stock funds can come in 2 major types, ETFs or mutual funds. ETFs are usually available commission-free and without a minimum purchase requirement at most major online brokers. However, mutual funds may require a minimum purchase and online brokers may charge a commission to trade them. Number 7. REIT Index Funds. Overview. A real estate investment trust, or REIT, is one of the most attractive ways to invest in real estate. REITs pay out attractive dividends in exchange for not being taxed at the corporate level, and REIT index funds pass those dividends along to investors. Publicly traded REIT funds can include dozens of stocks and allow you to buy into many subsectors, lodging, apartments, office, and many more, in a single fund. Through a managed fund, you can get access to real estate without worrying about the property management. Investors who are looking for diversification of exposure will have a good option through this avenue. Who are they good for? REIT index funds have high dividends, making them an attractive place for investors who are looking for income. They can also grow in value over time, so there is a mix of different benefits. Prices of publicly traded REITs can fluctuate markedly, so investors need to take a long-term focus and be willing to deal with the volatility. Risks. Owning a REIT index fund can take a lot of the risk out of owning individual REITs, because the fund offers diversification, allowing you to own many REITs inside a single fund. But the fund price will fluctuate, especially as interest rates rise. Watch out for REITs or REIT funds that aren't publicly traded, however. Rewards. As an investor, you can earn a return by receiving dividends and or applying capital appreciation. Over time, a good REIT fund can make 10 to 12% annual returns with a fraction of that as cash dividends. Where to get them? You can purchase a REIT fund at any broker that allows you to trade ETFs or mutual funds. ETFs are typically commission-free, while mutual funds may charge a commission and require you to make a minimum purchase. Number 8. S&P 500 Index Funds. Overview. An S&P 500 index fund is based on about 500 of the largest American companies, meaning it comprises many of the most successful companies in the world. For example, Amazon and Berkshire Hathaway are 2 of the most prominent member companies in the index. Who are they good for? If you want to achieve higher returns than more traditional banking products or bonds, a good alternative is an S&P 500 index fund, though it does come with more volatility. An S&P 500 index fund is an excellent choice for beginning investors because it provides broad, diversified exposure to the stock market. An S&P 500 index fund is a good choice for any stock investor looking for a diversified investment and who can stay invested for at least 3 to 5 or 6 years. Risks. An S&P 500 fund is one of the less risky ways to invest in stocks because it's made up of the market's top companies and is highly diversified. Of course, it still includes stocks, so it's going to be more volatile than bonds or any bank products. It's also not insured by the government, so you can lose money based on fluctuations in value. However, the index has done quite well over time. The index rallied furiously after its pandemic-driven plunge in February 2020, but performed poorly in 2022. So investors may want to proceed with caution and stick to their long-term investment plan. Rewards. Like nearly any fund, an S&P 500 index fund offers immediate diversification, allowing you to own a piece of all of those companies. The fund includes companies from every industry, making it more resilient than many investments. Over time, the index has returned about 10% annually. These funds can be purchased with fixed costs, and they're some of the cheapest index funds on the market. Where to get them? You can purchase an S&P 500 index fund at any broker that allows you to trade ETFs or mutual funds. ETFs are typically commission-free, so you won't pay any extra charge, whereas mutual funds may charge a commission and require you to make a minimum purchase. Rewards. Like nearly any fund, an S&P 500 index fund offers immediate diversification, allowing you to own a piece of all of those companies. The fund includes companies from every industry, making it more resilient than many investments. Over time, the index has returned about 10% annually. These funds can be purchased with fixed costs, and they're some of the cheapest index funds on the market. Where to get them? You can purchase an S&P 500 index fund at any broker that allows you to trade ETFs or mutual funds. ETFs are typically commission-free, so you won't pay any extra charge, whereas mutual funds may charge a commission and require you to make a minimum purchase. Number 9. Nasdaq 100 Index Funds. Once the Nasdaq 100 Index reaches the desired capital, an index fund based on this is a solid choice for most investors. The diverse list of companies included in the index ensures that there is some diversity and no risk of only being invested in a few companies or losing a lot if they go bankrupt. The fund is based on the largest companies in the Nasdaq index. In general, this means they are among the best and most stable companies available. Such companies include Apple and Alphabet, each of which comprises a large portion of the total index. Microsoft is another prominent member company. Who are they good for? A Nasdaq 100 index fund is a good selection for stock investors looking for growth and willing to deal with significant volatility. Investors should be able to commit to holding it for at least 3 to 5 years. Using dollar-cost averaging to buy into an index fund can help reduce your risk compared to buying in with a lump sum. Risks. Like any publicly traded stock, this collection of stocks can move down too. While the Nasdaq 100 has some of the strongest tech companies, these companies also are usually some of the most highly valued. The highly inflated valuation that the likes of Uber, Airbnb, and Lyft are currently at makes them more susceptible to a downturn. They also have a higher chance of going up quickly during periods of economic recovery. Rewards. A Nasdaq 100 index fund offers you immediate diversification, so that your portfolio is not exposed to the failure of any single company. The best Nasdaq index funds charge a very low expense ratio, and they're a cheap way to own all the companies in the index. Where to get them? Nasdaq 100 index funds are available as both ETFs and mutual funds. Most brokers allow you to trade ETFs without a commission, while mutual funds may charge a commission and have a minimum purchase amount. Number 10. Rental housing. Overview. Rental housing can be a great investment if you have the willingness to manage your own properties. To pursue this route, you'll have to select the right property, finance it or buy it outright, maintain it, and deal with tenants. You can do very well if you make smart purchases. With housing prices cooling off in 2023 and mortgage rates off their highest levels, investing in real